Welcome back to The Week Ahead. This isn't a hype show, it's not a prediction contest, and it's definitely not a place where we try to trade every headline. Every episode, we step back from the noise and focus on what actually matters. The signals shaping capital, policy, and markets over the next decade, not just the next day. Now, markets are sitting near record highs again, and depending on which headline you read first, you could feel excited, nervous, or flat out confused. Geopolitical tension, it's still there. Health scares, it's still there. Inflation, well, it's kind of hanging around like an uninvited guest that doesn't seem to know the party's over. But when the headlines get loud, I always try to focus on what the market is actually saying underneath the noise. And right now, the market is signaling something very important. It's not just strong, it's actually broadening out. And honestly, that's healthier than we've seen in the last couple of years. Now, we've been talking about this for a long time. You've heard me say this many times, I'm sure. But the market was being carried by just a handful of giant technology companies. You've heard of them before, the Apples, the Amazons, the Microsofts of the world. If you owned those names, life felt pretty good. If you didn't, well, it kind of felt like the entire market was happening somewhere else. But this year, that story is changing. So far, the so-called Magnificent Seven have only accounted for about 15% of the S&P 500's return. That means leadership is finally spreading out. So, a couple examples. Energy is participating. Industrials are participating. You've got materials, that sector that's also participating. Small caps, mid caps, even international stocks are starting to perform. Now, that's not exactly the flashy stuff that people brag about at dinner parties, right? But sometimes boring is beautiful. Diversification is often called the only free lunch in investing. And this is what that looks like in real life. A healthier market has more than one engine pulling it forward. Now, at the end of the day, that doesn't mean there won't be volatility. It just means the foundation underneath the market may be getting sturdier. And that matters a lot for long-term investors like ourselves. Now, the other thing that we're watching is what's happening inside the software and AI world. So we've officially moved from the hype phase into the execution phase. Now, what exactly does that mean in plain English? Well, investors are done rewarding companies just for saying AI 50 times on an earnings call, right? That now they want proof. And what is that proof? Well, can management actually use AI to lower costs? Can we improve margins, increase productivity, grow the cash flow of the company? Because AI, it's not a magic wand. It's really a tool. And like any tool, outcomes depend on who's using it. So think about it this way. A hammer in the hands of a carpenter builds a house. A hammer in the hands of a toddler breaks a lamp. And I had to chuckle about this when I was kind of preparing because honestly, I got a reminder of that this weekend. My 1-year-old son, Grayson, somehow he managed to push over a lamp in the living room, and he did it without even needing a hammer. So coming back to this concept, same environment, but a different outcome. And that's exactly what the market is sorting through right now. So there's been a number of companies out there now that are getting rewarded because investors see evidence that AI is actually helping the business. Now, there's others out there on the flip side that are getting punished because the transition looks messy or uncertain. So again, it doesn't mean software is dead. It just means the market's finally separating the builders from the talkers. And that's healthy. But there's another signal underneath the surface that deserves some attention too, and that's the labor market. And this is the final takeaway here. Now, the latest jobs report looked pretty good at first glance. The economy added about 115,000 jobs. That was double the expectations. It sounds great, right? But the fine print tells a little bit more of a nuanced story. Most of the gains came from lower paying service and healthcare jobs, while higher paying sectors like technology and finance are actively losing positions. Now, at the same time, some companies are quietly scaling back benefits like 401k matches and parental leave. These things matter, right? Because the American consumer is still the engine of this economy. And if labor quality starts softening around the edges, consumers may eventually feel more pressure than the stock market currently reflects. So this is one of those moments where two things can be true at the same time. That's kind of weird, right? But it's true. The market can remain resilient and parts of the economy can still be cooling underneath the surface. That's why we try not to overreact to headlines, either good or bad. We pay attention to the details. Now, looking ahead to this week, the biggest thing on the calendar is this week's April CPI inflation report. Inflation is still the gatekeeper for interest rate expectations. If inflation comes in softer, markets are, probably may start leaning harder into future rate cut expectations. But if inflation stays sticky, meaning if costs remain high, the Fed may have less flexibility than investors are hoping for. And what's interesting is this CPI report arrives during a pretty important transition period at the Federal Reserve. So Jerome Powell's term wraps up Friday. Kevin Warsh, his nomination process continues into the Senate. So fresh inflation data plus changing Fed leadership, it's more than enough to move markets as we head into summer. So what do we actually do with all of this? Here is the practical takeaway. Don't let the record highs make you reckless. And do not let scary headlines convince you the sky is falling every other Tuesday. This still looks like a market where discipline, diversification, and selectivity matter more than trying to predict every twist and turn. You don't need to own everything, but you also probably don't want your future depending on one theme, one stock, one sector, or one outcome either. Now, this past weekend for Mother's Day, we took the kids out on the e-bikes, and we rode the Sugar Creek Greenway Trail up towards Freedom Park. So most of you probably know where I'm talking about and have been on that trail, or at least have been in the park at one time or another. Now, on paper, it was a pretty straight shot, but in reality, as many of you know who have had kids, riding with a 1-year-old and an almost 3-year-old means you're going to stop constantly, right? Somebody gets thirsty. Somebody needs a snack. Caden gets a bug in his eye. Grayson loses his pacifier. So every few minutes, we had to pause and adjust course. But here's the important part. The interruptions, while it was frustrating to mom and dad, right, it didn't derail the trip. We still made it to the playground. We still made it to burgers, fries, and milkshakes afterward. And honestly, investing can feel a lot like that sometimes. Markets pause. The economy cools off. Headlines interrupt the journey. But temporary turbulence, it's not the same thing as being lost. And the goal is not to panic every time you hit a bump in the trail. The goal is to stay disciplined enough to keep moving toward where you were trying to go in the first place. So this week, let's keep our helmets on, let's stay flexible, and remember, progress rarely happens in a perfectly straight line. Until next time, I'll see you next week, prepared, not surprised.